Okay, let's unpack this. Welcome back to the deep dive.
This is where we take those, well, pretty dense financial reports.
Stacks of them sometimes, footnotes, accounting standards, just sheer volume.
Exactly, and we try to boil it all down.
Into clear, actionable knowledge. Stuff you can actually use.
Yeah.
Hopefully giving you an edge.
Yeah, our goal is really to give you the context, the critical insights you need to understand why markets move, why management makes certain decisions.
Without needing to become, full-time auditor yourself.
Right, we're here to sort of guide you through the noise.
Absolutely. And hey, if you find this kind of deep dive analysis valuable, could you do us a quick favor? Hit that subscribe button, maybe give us a like. And if you know someone else navigating these markets, share this with them.
Yeah, sharing good structural analysis is, well, it's a great way to help your network.
It really is.
No.
Okay, so today we are doing a crucial dive.
A really important one. We're looking into the financial health, the strategic direction of Alarko, Garimenko, Yaturim, or Takuluo. LGYO.
LGYO, yeah. Specifically, we're dissecting their consolidated financial statements and their activity report.
And this covers the first 9 months of 2025, so January 1 right through to September 30th.
This period, I mean, it's a stress test for pretty much every company in Turkey, right?
Definitely. But maybe especially for a major real estate investment trust, a GYO, like LLGYO.
We're looking at how they navigate what seems like a really hostile environment. 3 big forces hitting them at once.
What are those?
Well, aggressive capital spending, these huge investments they're making. Then you've got soaring interest rates, making borrowing expensive.
And the big one.
And the big one, yeah. Hyperinflation. The pervasive effects that forced them into using inflation accounting, TMS 29.
That TMS 29 context is absolutely essential. We can't stress that enough.
Right. So every number we talk about today,
unless we explicitly say otherwise,
is adjusted for inflation. It reflects purchasing power as of September 30, 2025.
Which adds a huge layer of complexity, doesn't it? Financial results suddenly depend not just on, selling stuff or renting property,
but on how well the company positions itself against the lira losing value.
Exactly. Financial positioning becomes critical.
And what really jumps out from this report, for me anyway, is the conflict, this inherent tension.
Go on.
You've got management pushing this extremely aggressive, really capital-intensive growth strategy. It's a huge bet on future luxury tourism income.
Right, with the Bodrum project especially.
Yeah, but at the exact same time, they're fighting these crippling financing costs, and they're trying to deal with new regulations too.
It's a high-stakes balancing act, a real tightrope walk.
For sure. And you mentioned the complexity of TMS 29.
Yes, the inflation accounting. It creates these large, non-operational items, like the net monetary position gains or losses.
Which can look good on paper.
It can absolutely help the bottom line, masking the real sting of those rising borrowing costs.
So our job today really is to peel back that accounting layer.
And ask, what does the core operational performance truly reveal? What's really going on underneath?
That's the mission. Let's get into it. Okay, first things first. Let's ground ourselves. Who exactly is ALGYO?
Well, it's not a new kid on the block. It's been around a while.
A venerable institution, you might say.
You could. It was formally set up in Istanbul way back in 1978.
Wow, okay.
Although it adopted the current structure, the GYO structure, and the LGYO name more recently in 1996.
And that change in 96 put it under the Capital Markets Board, the SPK.
Exactly. Strict regulatory oversight comes with being a GYO.
So as a GYO, its main business is pretty clear-cut, legally speaking.
Yeah, investing in real estate assets, developing projects, and also holding some capital market instruments, that's the mandate.
And their head office is in Ortaköy, Beşiktaş, Istanbul, right in the thick of things.
A major player, definitely. But it's their strategy that really defines them, I think.
How so?
Well, unlike some other GYOs that might focus on, say, mixed-use developments or standard apartment blocks.
More generic stuff.
Maybe. LGYO seems to have really doubled down on high-value strategic assets, assets that generate income, and particularly, it seems, in the tourism sector.
You could really see that focus when you look at their main properties, can't you? Their key portfolio highlights.
Absolutely. I mean, we're talking about the Hillside Beach Club in Fethia. That's nationally known, right? A consistently high-performing asset for them.
And then there's the big one, the massive project that's sucking up capital right now. The Bodrum Hotel.
Which is deep in renovation, a huge undertaking.
It's not just tourism, though, is it? They have other commercial properties.
That's right. Beyond tourism, they hold significant commercial real estate, too. Centers in Carrico, Ankara, Etler Alkent, and also the Ayuk factory site. So some diversification there.
So when we think about their competitors, it's not just any property developer.
No, I'd say their peers are really other large established GYOs, probably linked to holding companies that also focus on that high-end commercial and institutional asset ownership.
So they occupy a specific niche, kind of the top end of the market.
I think that's fair to say. And the activity reports, the latest ones, they just confirm the strategic focus, especially when you look at the investment section.
The leveler, the additions to property value.
Exactly. That section tells you exactly where management is placing its bets, where the money's going.
And it's pretty stark, isn't it?
It really is. You see this monumental addition, 2.88 billion Turkish lira, poured into the Bodrum Hotel project just in the first 9 months of 2025.
That's not just fixing a few things. That's a complete overhaul.
Total capital overhaul, expansion. It's massive. And then on top of that, another 210.7 million TL went into the Hillside Beach Club.
So the takeaway is clear. Their capital allocation strategy is aggressive.
Very aggressive and highly concentrated, almost entirely focused on maximizing the future value, the future revenue of these two luxury tourism assets.
Which, for you as an investor, is crucial to grasp, right?
Absolutely.
Yeah.
Because while it offers potentially huge future upside, if those projects succeed and the tourism market stays strong,
There's always an if.
there's always an if. It inherently ties their risk profile very tightly to the fate of the high-end leisure market in Turkey.
Okay, let's shift to ownership. Who actually controls ALGYO?
Well, it's publicly traded. The public float is 48.77%, so nearly half the shares are out there. But, as you often see in Turkey, the controlling interest stays firmly within the founding group's ecosystem, in this case, Alarko.
So Alsim Alarko Sanayi Tesisleri holds.
They hold 34.78%. And the parent company, Alarko Holding A, holds another 16.42%.
Meaning that strategic decisions, big picture stuff, are ultimately made within the context of the wider Alarko Group strategy.
That's almost certainly the case.
Okay, what about the people running the show, management and governance?
The board has 7 members. They serve a 3-year term, which actually just started in May 2024.
And governance-wise, you mentioned something positive, but diversity and independence.
Yes, this was quite notable. The female representation on the board, there are 3 women members.
Out of 7.
Out of 7, yes. Bedraya Banu Koker, Neslihan Tombol, and Nergis Ayvaz Boumediene. That's 42.8% female representation, which is pretty high.
That is good. And independence.
What's arguably even more significant is that all 3 of these female members are listed as independent directors.
Interesting. So having nearly half the board as independent directors and all of them being women, that sends a strong signal, doesn't it?
I think it does. It's a strong governance indicator, especially in a structure where, related party dealings and controlling shareholder interests are always something to watch. It suggests a commitment to having some outside oversight.
Okay. And what about how much the top brass are paid? Executive compensation.
We looked at that too, and maybe surprisingly, given the scale of the projects, it showed some restraint.
Really?
Yeah, the total gross pay for the senior execs for the first 9 months of 2025 was 20.21 million TL.
And how does that compare to the previous year?
It's actually down slightly. It was 21.60 million TL for the same period in 2024. That's despite the high inflation and, overseeing these massive investments.
So they're spending billions on assets, but keeping a lid on core management costs. Yeah, that's interesting.
It is. We also see the standard committee structure you'd expect. Corporate governance, audit committee.
And you mentioned a risk committee.
Yes, a very active risk early detection committee. It submitted 5 reports just in this 9-month period.
Which tells you that management is formally acknowledging the high-risk game they're playing with these big investments.
Absolutely. They know the environment is risky.
Okay, one last bit on structure. Personnel and subsidiaries. How many people actually work there?
It's a tiny core team. The headcount averaged only 20 employees during this period.
20. That's it.
That's it. Up slightly from 18 in 2024, but still very small.
Which just confirms the GYO model, right? They aren't building the hotels or running them day to day.
Exactly. They're essentially financiers and asset managers. They own the assets, oversee the big strategy, and outsource the operational stuff.
And their international footprint, is there much?
It's minimal, really restricted to just one consolidated subsidiary, Alarko OJSC.
Where's that?
That's in Russia. It's 100% owned by LGYO, and it's purely focused on real estate there.
So while their financing might involve foreign currency, as we'll see, their actual physical assets, their operations, are overwhelmingly focused domestically on these high-value Turkish properties.
That seems to be the picture, yes.
All right, you've got the company profile down. Let's transition to the numbers. The profit and loss statement. This is where things get really interesting.
Okay, P&L deep dive. We're comparing the first 9 months of 2025 against the same period in 2024. And crucially, remember, everything's inflation adjusted.
Got it. So starting at the top line, revenue. Haslat. How did that look?
It showed solid growth, actually. It went from 458.55 million TL in 2024 up to 509.98 million TL in 2025.
Okay, what's that in percentage terms, roughly?
That's about an 11.2% increase in real inflation-adjusted terms.
You know, in this kind of market, getting double-digit real revenue growth, that's pretty significant.
It absolutely is. The question is what's driving it? What's the main pillar holding up that revenue?
Rent, I assume.
Exactly. It's the rental income. That's the bread and butter for a GYO. Kira Jalirali rose from 451.25 million TL to 474.77 million TL. It completely dominates the revenue stream.
And there's a reason it's so stable, right? Something about the hillside lease.
Yes, the footnote explains it. That lease for the Hillside Beach Club is indexed to the US dollar. There's a minimum annual rent set at just over 2.58 million US dollars plus some revenue sharing on top.
Ah, that dollar linkage. That's a smart move in this environment, a brilliant hedge.
It really is. It ensures their primary recurring revenue stream largely keeps pace with inflation, maybe even beats it, depending on the exchange rate. It provides real stability in an unstable economy.
Okay, stable revenue, dollar-linked. Sounds good. Now, costs.
Right. This is where we start to see the impact, the price tag of that aggressive growth strategy we talked about.
You mean the cost of sales, such as Slaughter Malietti?
Yes, or cost of services provided. It just exploded. It jumped almost fivefold.
Fivefold, wow. From what to what?
From 14.4 million TL in 9M 2024 to 69.41 million TL in 9M 2025.
Okay, that's a huge jump, and that's directly linked to the big investments.
Almost certainly. That 3 billion TL in capital additions we mentioned for Bodrum and Hillside, well, it isn't free. It comes with substantial immediate operational costs. Things like construction oversight, site management, project management fees, maybe even some financing costs that get partly capitalized but still flow through here.
So revenue up, but costs way, way up. How did that affect the gross profit? Budkar.
This is where it gets interesting. Despite that massive surge in input costs, the gross profit held remarkably stable. It only dropped slightly.
Really? From what?
From 444.15 million TL down to 440.57 million TL. Barely a change.
So the underlying profitability of the assets is strong enough to absorb that cost shock.
It seems so. That high-margin rental income structure basically soaked up the hit from the increased service costs. Yeah. Very robust.
Well, I sense a but coming.
There is a but, because the picture clouds over immediately when we drop down a line to core operating profit. İsas Faaliyet Kardida.
Okay, what happened there?
This figure saw a dramatic decline, a really significant drop.
How much?
It fell from 753.97 million TL in 2024 down to 590.54 million TL in 2025.
Whoa. That's a fall of, what, over 20%?
About 21.6%, yeah. A big drop in the profit generated from their day-to-day business.
But wait, how can gross profit be stable, yet core operating profit drops so much? What explains that gap?
This is a classic case of needing to look one level deeper. You have to dig into the, let's say, more volatile or non-recurring operational items.
Okay.
The main culprit here is a line item called İsas Faaliyetlerden Gelirler, other operating income.
Other operating income, what did that do?
In 2024, that line item was exceptionally high. It was 523.82 million TL.
Ah, I see. So that massive operating profit figure they had in 2024 wasn't really sustainable, wasn't just core rental income?
Exactly. It was significantly inflated by something else, something that just didn't repeat in 2025.
Any idea what that something else was? Specific games?
Yes, the footnotes give clues. For example, that huge 2024 other income figure included 351.1 million TL in massive cambio carlari.
FX gains. Foreign exchange gains.
Yes, huge FX gains, likely from holding certain foreign currency assets or maybe some shrewd short-term currency management back then. Those gains just evaporated in 2025, dropping sharply to only 98.6 million TL.
So management caught some favorable currency swings in 2024 that just weren't there. or weren't achievable in 2025.
That seems to be the case. So the takeaway is that the 2025 core operational performance, while it looks weaker on paper compared to 2024,
It might actually be a more realistic, more sustainable reflection of their core asset management income without those big volatile FX gains.
precisely, it strips away some of that one-off noise from 2024.
Okay, that makes sense. Now we get to the two lines that you said really define this whole report.
Yes, financing costs and the inflation accounting effect. Let's start with the pain, the cost of debt.
How bad was it?
It's truly staggering. Finansman Gitter-Larry, the financing costs, jumped nearly 15 times.
50.
Yes, from just 13.5 zillion TL in the first 9 months of 2024 to a whopping 203.31 million TL in the same period of 2025.
Wow, 200 million in financing costs? That's huge.
An explosion. And it's the direct, unvarnished result of two things. The market environment, those high interest rates, coupled with management's deliberate decision to borrow heavily, to leverage up, to fund that Bodrum project.
200 million TL. That's enough to wipe out nearly half of their stable gross profit we talked about earlier.
It is. For almost any other business, seeing that kind of spike in financing costs would be a five-alarm fire. It would force an immediate stop to any major CapEx plans.
But this is where that unique feature of Turkish accounting comes in, the TMS 29 shield.
Exactly. This is where the hyperinflation accounting standard, TMS 29, steps onto the stage and plays a crucial role.
Okay, explain this net parasol potasyons kazancha net monetary position gain again. How does it work?
Right. So when you have hyperinflation, the local currency, the lira, loses purchasing power rapidly. Now, if a company holds more monetary liabilities, think things like bank loans denominated in lira, than monetary assets like cash in lira.
So if they owe more lira than they hold.
Basically, yes. Then they benefit from inflation in an accounting sense. Because the real value, the inflation-adjusted burden of that lira debt gets eroded away by the inflation itself. The debt becomes cheaper in real terms.
And LGYO managed to flip their position on this completely between the 2 years.
They did. It's a spectacular flip. In the first 9 months of 2024, they were actually on the wrong side of this. They reported a massive loss from their monetary position, 403.85 million TL.
Meaning they held more monetary assets than liabilities back then.
It suggests that, yes. And inflation eroded the value of those assets. But in 9M 2025, largely because they took on all that new debt.
They engineered a shift.
They engineered a complete shift. They moved into a net monetary liability position. And as a result, they reported a gain of 136.7 million TL from their monetary position.
Okay, let's just pause on that contrast because it's critical. They changed their debt structure so much that this non-operational inflation effect swung by over 500 million lira in their favor year over year.
It's a massive swing, from a 400 million loss to a 137 million RID gain.
And that 136.7 million TL gain, it's essentially non-cash income created by the accounting rules.
Correct. It's an accounting gain reflecting the erosion of their lira debt burden.
And it conveniently helps offset that huge 230 million TL cash expense from the financing costs.
It does. It's a masterful tactical use of the hyperinflationary environment from an accounting perspective. They borrowed heavily in inflation-eroding lira to fund real assets, the properties, which are protected because they're valued at fair market value. And then they used the TMS 29 gain to stop the soaring interest costs from completely crushing their bottom line profit figure.
It's complex financial engineering, really.
It absolutely is.
So after all this, the lower core operational performance, the massive financing costs, but then the big monetary gain.
Right.
Where did the final number land?
The net profit. Believe it or not, the net donum kara, the net period profit, actually ended up slightly higher in 2025.
Higher, even with everything.
Slightly higher. It came in at 354.14 million TL for 9M 2025, compared to 335.69 million TL for 9M 2024.
So the bottom line looks better. But the quality of that profit, how they got there, is completely different this year.
Vastly different. It's much less reliant on consistent core operational yield and much more reliant on successful financial maneuvering and navigating these complex hyperinflation accounting rules.
Which feels fragile.
It certainly introduces an element of fragility, and this translates directly to the earnings per share, the EPS.
How'd that look?
It saw a moderate increase, from 1.2195 TL per share in 2024 up to 1.2866 TL per share in 2025.
So on paper, a positive result for shareholders, one that, as you say, seems quite dependent on the continuation of this specific high inflation, high debt environment and their positioning within it.
That's a very good summary of the P&L story.
Okay, let's shift focus now from the income statement to the balance sheet. Let's look at the assets, the investments, the concrete results of this strategy.
Right. The asset base. Total assets for ALGYO grew quite substantially over the first 9 months of 2025.
How much growth are we talking?
They went from 22.6 billion TL at the end of December 2024 up to 24.6 billion TL by the end of September 2025.
So an increase of about 2 billion TL in assets. Where did that growth mainly come from?
It's almost entirely driven by one line item, investment properties. Yatırım amaçlı gayrimenkul.
The actual real estate they own.
Exactly. Those assets ballooned from 20.11 billion TL up to 23.39 billion TL. They absolutely dominate the balance sheet, nearly 95% of total assets.
So the asset base is getting bigger, and as we discussed, it's getting more concentrated in those big renovation projects.
That's right. Let's revisit that 3 billion TL investment figure we saw impacting the costs. But look at it from the asset side now. Note 7 in the report really breaks it down.
Okay, what does Note 7 confirm?
It confirms exactly what we suspected. That huge 2.88 billion TL investment went into the Bodrum Hotel, and the 210.7 million TL went into Hillside Beach Club. It shows the financial statements aren't just abstract numbers. Management is really executing this high-stakes, high-cost investment plan.
And they're focusing that spend on upgrading the existing portfolio, right? Not buying new plots of land or diversifying wildly.
Correct. It's very much a strategy of doubling down on enhancing their current prize assets.
We should also probably reiterate the valuation method here. These aren't listed at what they paid for them years ago.
No, absolutely not. That's crucial. These investment properties are recorded at fair value, not historical cost.
And who determines that fair value?
Independent certified appraisers. The report mentions Real, Gayrimenkul, Desserlim, and Nexia Peccioli Consulting.
So that 24 billion TL asset figure is constantly being updated to reflect current market conditions.
Yes. It gets recalibrated based on professional valuations, which, by the way, provides another crucial hedge against inflation for their balance sheet. The value of their core assets should, in theory, rise with inflation.
Okay, that's important context.
Yeah.
Now, to really understand the sheer commitment to this growth strategy, you said we need to look at the cash flow statement.
Yes. The P&L shows profit, which includes non-cash items like that monetary gain. The cash flow statement tells you where the actual hard cash went. Did they generate it? Did they spend it?
Right. Let's start with cash from operations, their core business. Section A. How healthy is that?
It's outstandingly healthy, really strong. They generated nearly 2.3 billion TL in cash from operations in the first 9 months of 2025.
2.3 billion. How does that compare to last year?
It's more than double. In the same period of 2024, they only generated about 970 million TL from operations.
Wow. So their core rental business is just spinning off tremendous amounts of cash. A powerful engine.
A highly efficient cash machine, yes. However,
here comes the other side of the coin.
Exactly, the investment cash flow. Section B of the statement. This tells the story of where all that cash immediately went.
Okay, what does Section B show?
It shows a massive outflow of cash for investments. 3.07 billion TL flowed out in 9M 2025.
3.07 billion. And how does that compare?
Again, roughly double the previous year.
Yeah.
In 9M 2024, the investment outflow was 1.59 billion TL.
Okay, let's put those two numbers together because this is stark. They generated 2.3 billion in cash from running the business. But they immediately turned around and spent 3.07 billion on capex, mostly that Bodrum Hotel.
Precisely. So the conclusion for you, the individual investor watching this, is crystal clear.
What is it?
Not only is every single lira of cash generated by operations being reinvested back into the company.
They're spending even more than they generate.
Yes. They had to find an additional 770 million TL or so,
What?
3.07B outflow, 2.3B inflow, just to fund the current pace of construction and investment.
Where'd that extra cash come from? Presumably borrowing, which we'll get to.
We will. But the strategic point here is, this confirms a deliberate zero-distribution hyper-growth model. All cash is plowed back into assets.
Which immediately raises a question, doesn't it? About liquidity.
Yeah.
Day-to-day cash management.
It absolutely does. This model brings us straight to the, well, slightly thorny issue of working capital. And for investors used to looking at, say, manufacturing firms or retailers, LGYO's situation here might set off alarm bells.
Why? What do the ratios show?
Well, the report shows both the current ratio, that's current assets divided by current liabilities, and the quick ratio.
Which excludes inventory, though that's less relevant for GYO.
Right. Both of those ratios stand at 0.53.
0.53. Okay, in traditional finance, anything below 1.0 is usually seen as a warning sign, isn't it?
It is. It implies that their short-term liabilities, the bills due within a year, which total 2.13 billion TL.
Significantly exceed their liquid short-term assets, cash, receivables, etc., which are only 1.12 billion TL.
So on paper, they can't cover their immediate obligations with their immediate assets. There's a working capital deficit.
Now, the activity report, management's commentary, apparently suggests their net working capital is sufficient.
Yes, they do state that. They attribute it to the nature of GYO operations and their financing capabilities.
So is that just reckless optimism? Or is there a structural reason why a GYO can operate like this?
It's largely structural, but it definitely carries high risk. Let's break it down.
Okay.
A GYO's main assets are those huge multi-billion lira properties. They're fundamentally illiquid. You can't sell a hotel wing tomorrow to pay a bill.
Right.
But as we saw, those assets generate very predictable, very large cash flows. That 2.3 billion TL in operating cash flow is proof.
Okay.
Now, their short-term liabilities often include things like payments due to construction contractors for the Bojum project or scheduled repayments on bank loans. Management's plan, their assumption, is that they'll cover these liabilities either by refinancing the debt, rolling it over,
Or simply from the next big rent check coming in from Hillside, which is pretty much guaranteed.
Exactly. So that low 0.53 ratio is more a symptom of this asset-heavy, operationally cash-rich, but balance sheet cash-light business model, rather than necessarily a sign of mismanagement.
But it highlights a critical vulnerability, doesn't it?
It exposes them acutely to one major risk: refinancing failure. What happens if interest rates spike even higher than they are now? Or what if credit markets suddenly freeze up, making banks unwilling to lend or roll over debt?
Then their reliance on borrowing more or getting those future rent payments to cover that 2.13 billion TL in short-term liabilities. It could become a huge problem very quickly.
Catastrophic, potentially. If the funding dries up, they can't pay their bills.
So the bottom line on liquidity is the model works as long as the operational cash keeps flowing strongly and the debt markets remain open and accessible to them.
Yes. Their financial structure explicitly relies on continuous credit availability and the ongoing confidence of their lenders. Take one of those away, and they're in immediate trouble.
That reliance on credit brings us neatly to the next section, debt. Borsaluka. And the structure of that debt has changed quite dramatically, hasn't it, to support that massive investment spending?
It really has. Let's look at the total borrowings first. Note 5 gives us the details.
Okay, total debt.
It increased significantly. From 2.03 billion TL at the end of 2024, it rose to 2.74 billion TL by September 2025.
That's roughly a 35% increase in inflation-adjusted lira terms in just 9 months.
Correct. That growth, while substantial, is basically the price tag for the expansion for funding that capex gap we saw in the cash flow.
But it's not just the total amount that changed, is it? It's the type of debt, the maturity.
Exactly. And this is where it gets, well, potentially alarming. The composition shifted dramatically towards the short term.
How so?
Short-term liabilities, Kisa, Vadeli, Yukimlulukler, just ballooned. They went from about 701 million TL at the end of 2024 to 2.13 billion TL by September 2025.
Wow, tripled almost. And what drove that surge?
Crucially, they took on nearly 1 billion TL in new short-term bank borrowings. That specific line item, short-term borrowings, was actually zero at the end of 2024. Now it's 987 million TL.
So they deliberately went out and borrowed 1 billion lira on short terms, less than a year.
It appears so. And at the same time, their long-term debt actually decreased slightly from 1.43 billion TL down to 1.21 billion TL.
Okay, so swapping long-term stability for short-term funding, why would they do that?
It's likely a high-risk gamble. They might have gotten slightly better interest rates initially on short-term loans, or perhaps those funds were easier to access quickly to pay for the fastest-moving parts of the construction work.
But it massively increases the pressure, doesn't it?
It massively compounds the refinancing risk we just discussed. They've deliberately concentrated a huge chunk of their debt into the short-term maturity window.
Meaning they now have to find a way to roll over or repay a very large amount of debt within the next 12 months.
Yes. If you add that new 987 million short-term borrowing to the current portion of their long-term debt that's also due within a year, you're looking at probably upwards of 1.5 billion TL in debt that needs addressing very soon.
That feels like walking a tightrope.
It does add significant pressure. However, we need to provide context here for the investor. While the absolute amount of debt is up and the shift to short-term is risky,
Their overall leverage is still low.
Relatively speaking, yes. We need to look at the Borsa's kaynak or ANA, the debt-to-equity ratio.
Okay, what's that number?
It's 42.61%.
42.61%. And how does that stack up against the regulatory limits for a GYO?
The SPK, the regulator, actually allows GYOs to leverage up to 500% of their equity, 5 times their equity.
500%. Wow. So 42% is actually incredibly modest compared to what they could borrow.
Exactly. Their equity base is huge, over 17 billion TL, thanks to those revalued properties. So relative to the massive value of the assets they own, their overall leverage is still quite low.
So the risk isn't really about the company going bankrupt due to too much debt overall.
Probably not systemic insolvency risk, no. The risk is much more immediate. It's about short-term liquidity, managing that upcoming refinancing hump, and crucially, the cost of that debt in this high interest rate environment.
Okay, that clarifies the debt picture. Now, let's talk about what you call the single most dramatic strategic shift in the report.
Yes, foreign currency risk, FX risk. Note 17 lays this out, and it seems management made a very conscious, very high-stakes decision here.
What did they do?
At the end of 2024, ALGYO was playing it safe with FX. They were nearly net neutral. In fact, they reported a small net FX asset position of about 140 million TL.
Meaning they held slightly more foreign currency assets than liabilities. So they're relatively protected if the lira fell.
Correct. They were pretty well hedged, or at least not exposed. But by September 2025, just 9 months later, they'd done a complete 180-degree turn.
What did the position become?
They landed on a significant net FX liability position of 2.18 billion Turkish lira.
Minus 2.18 billion. So they owe 2.18 billion lira more in foreign currency than they hold in foreign currency assets.
Exactly. That's a negative exposure swing of over 2.3 billion lira in just 9 months, from slightly positive to massively negative.
Why? Why on earth would a company operating mainly in Turkey, earning rent, mostly in lira, even if indexed, suddenly take on such a huge net foreign currency liability? What's the thinking?
The most logical explanation points directly back to the CapEx, that massive Bodrum hotel project.
How so?
Think about what goes into a luxury hotel renovation. Heavy machinery, specialized materials, perhaps high-end finishes, maybe even specific international contractor expertise. A lot of those inputs likely need to be paid for in euros or US dollars.
So to fund those foreign currency costs for the project.
They likely took on significant new debt denominated in euros or dollars. It might have been cheaper or more readily available than lira loans at the time, and it matched the currency they needed to spend.
Okay, that makes sense as a reason. But taking on 2.18 billion in net FX liability, are they hedging this risk? Are they using financial instruments to protect themselves if the lira falls further?
Well, the report, specifically Note 17 on financial risk management, doesn't detail any significant hedging instruments like forwards or swaps that would cover this scale of liability.
So they're just sitting on it, unhedged.
It strongly implies that management is accepting a massive unhedged currency exposure. They are essentially making a high-stakes bet.
A bet on what? That the lira will suddenly strengthen. That seems unlikely.
Unlikely, yes. The bet is probably twofold. Either that the lira somehow stabilizes, or, perhaps more likely, they believe that the real-term appreciation in the value of the underlying assets they're building the Bodrum Hotel, Hillside, will ultimately outpace any losses they incur from the lira depreciating against their euro or dollar debt.
That feels like a pure gamble on asset value outrunning currency depreciation in a highly volatile economy.
It is a significant gamble, and the sensitivity analysis in the report confirms just how dangerous it is.
What does the sensitivity analysis show?
It calculates that a mere 10% depreciation of the Turkish lira against the foreign currencies they're exposed to, mainly euro and USD,
Just 10%, which can happen quickly.
would result in a direct loss of 218.2 million TL hitting their profit and loss statement.
218 million loss from just a 10% currency move. That's huge. That single risk factor could wipe out nearly 2/3 of the entire net profit they reported for these 9 months.
Exactly. This is a critical risk factor for every investor watching LGYO right now. While their main rental income gets some protection from that USD indexation on the Hillside lease,
It's dwarfed by the liability side.
the sheer magnitude of the unhedged FX liability on the debt side means that macroeconomics, specifically the path of the Turkish lira, could completely negate any operational successes they achieve almost instantly.
Okay. Massive FX risk noted.
Right.
Finally, in this section, let's touch on the ilişkili taraf işlemleri, related party transactions, note 16.
Yes, these footnotes are always crucial, especially in group structures like Alarko. They reveal the operational plumbing, the connections within the ecosystem.
And the main connection seems to be with the operator of Hillside.
Yes, the primary related party is a Tosh Alarko Touristic Tesisler A. They are the company within the Alarko group that actually leases and operates the key Hillside Beach Club asset from LGYO.
So LGYO is the landlord, Atosh is the tenant operator. What do the transactions show?
Well, LGYO has significant receivables from Atosh totaling 366.6 million TL.
Meaning Atosh owes LGYO quite a bit of money.
Yes, likely for rent that's been recognized as earned but not yet paid, or perhaps for contributions towards the recent investments at Hillside. It shows LGYO is relying on its related party tenant to pay its bills on time.
And what about money flowing the other way? Does LGYO owe money to related parties?
Yes, and this figure jumped dramatically. Payables to related parties skyrocketed.
How much?
From only about 14 million TL at the end of 2024 to 212.4 million TL by September 2025. A massive increase.
What does that signal?
It signals that the huge investment activity, especially at Bodrum, is likely leveraging the entire Alarko Group infrastructure. LGYO is probably buying services, materials, or maybe even accessing intra-group financing lines from other Alarko companies to make the construction boom happen.
Deep integration. We also saw something about deferred income.
Yes, another significant item. 328.5 million TL of deferred income on LGYO's books comes from related parties, again, predominantly Atosh.
What would that be? Rent paid in advance.
That's the most likely explanation. Atosh has paid rent for future periods upfront. This helps LGYO's cash flow now, locking in future income, but it also deepens that operational and financial interdependence between the GYO and its main tenant operator.
Okay, so if we summarize the whole debt and risk picture,
I'd say LGYO looks structurally sound relative to its massive equity base, but it's critically exposed to short-term refinancing risk due to the shift in debt maturity. It's carrying a huge unhedged FX liability. And its operations and funding are heavily reliant on the financial and operational stability of the broader Alarko group, as shown by these large related party transactions.
one last point here. Guarantees.
Mm-hmm.
Did the company pledge its assets?
Yes, substantially. The report mentions Trey Teminat, Rehan, Apotek guarantees, pledges, and mortgages. LGYO has issued these against its own assets totaling 5.45 billion TL.
5.45 billion.
Yes, and this is entirely on its own behalf, not guaranteeing others. It underscores the enormous amount of collateral the banks require to secure the current level of financing needed for those huge investment projects. The assets are heavily pledged.
Okay, we've established management's clear priority.
Rare.
Growth, funded by reinvestment and debt. Growth above all else, it seems.
That certainly appears to be the strategy driving the numbers.
But now they're running headlong into a massive regulatory change, a conflict that threatens to directly penalize that exact strategy.
Yes, this is a really important context for the future. We're talking about the new GYO tax rule.
Which became fully effective starting January 1st, 2025, right?
Yeah.
So it impacts the earnings we're looking at.
Correct. And it's a potential game changer for any GYO, like LGYO, that prefers to keep its cash and reinvest internally.
What's the rule, in simple terms?
The mandate is straightforward, but potentially painful. To keep their corporation tax exemption status, which is a huge benefit, vital for their profitability. GYOs, like LGYO, must now distribute a minimum of 50% of their earnings derived from real estate activities as dividends to shareholders.
And 50% distribution, minimum.
Minimum. If they don't meet that 50% threshold, then the portion they fail to distribute is subject to a hefty 30% corporation tax rate.
Ouch. 30% tax on retained profits. That creates a direct clash with their strategy, doesn't it?
A massive strategic conflict. Management clearly wants to retain every single lira of profit to plow back into that 3 billion lira Bodrum project and pay down debt. But the government is now saying, nope, you have to distribute at least half of that profit or we'll tax the retained part heavily.
So they face a tough choice. How can we gauge which way management is leaning? Can we look at their past actions?
We absolutely can. The best indicator is their decision regarding the distribution of the profits earned in 2024, a decision made during 2025, just as this rule was coming into full force.
Okay, what was their official dividend policy before this rule?
Their stated policy, according to the report, was quite vague. It said they aimed to distribute at least 5% of distributable profit.
Only 5%. That's a very low bar, setting expectations low.
Very low. But their action on the 2024 net distributable profit, which was a significant 441 million TL, spoke much louder than the policy.
What did they decide to do with that 441 million?
It was decisive. At the General Assembly meeting held in April 2025, the decision was made by majority vote, Wisakluzu, the report says, to retain 100% of it. Zero distribution.
Zero. They distributed nothing from the 2024 profits.
Nothing. And the report explicitly states the reason: to strengthen the company's financial structure and, crucially, to finance investments.
Okay, that couldn't be a clear signal to you, the investor. Management's default position, their absolute preference, is reinvestment in internal capital generation.
They proved they were willing to forego distributions entirely, even significant profits, to keep fueling that CapEx pipeline for Bodrum and Hillside.
But now going forward, for the 2025 earnings we've been analyzing, which would typically be considered for distribution in 2026, they face this dilemma starkly because of the 50% rule.
Exactly. The strategic tension is immense. They have a choice to make.
Option 1. Compromise on the high CapEx spending rate, maybe slow down the Bodrum project slightly, and distribute 50% of their real estate earnings as dividends to avoid the tax.
Option 2. Stick to the aggressive CapEx plan, retain the cash they feel they need for the projects, but incur that 30% tax penalty on the undistributed portion of their profits.
That could be hundreds of millions of lira in tax, couldn't it? Is management really willing to pay that much tax just to keep the Bodrum project pedal to the metal?
That is the defining question for LGYO over the next year or two. Their decision here will speak volumes about their ultimate commitment to this growth path versus shareholder returns or tax efficiency.
A fascinating conflict to watch unfold. Okay, looking further ahead, the report also mentions some new accounting standards coming down the pike. Note 2.5.
Yes, just briefly. It's always good to be aware of the evolving landscape. They mention upcoming impacts from new international standards, particularly IFRS 18.
IFRS 18. What's that about and when does it hit?
It's set for adoption around 2027. And for an investor trying to compare LGYO to its peers, maybe even globally, it's potentially quite helpful.
Yes.
IFRS 18 is mainly focused on improving and standardizing the presentation of financial statements. It's going to require companies globally to use more defined categories for income and expenses, specifically separating things clearly into operating, investment, and financing activities on the P&L.
And crucial.
Crucially, it mandates new standardized subtotals within the P&L, including a formally defined, clear operating profit figure.
So that might help address the complexity we saw earlier, where LGYO's core operating profit was kind of muddied by those volatile other operating income items like FX gain.
Exactly. IFRS 18 should force greater clarity and consistency in reporting operating results. It might make it harder for management to blend volatile, non-core gains with the true underlying profitability of the rental business. It pushes towards transparency.
Any other future standards mentioned?
They also briefly note forthcoming changes to IFRS 9, the standard on financial instruments, related to classifying assets tied to ESG environmental, social, and governance goals.
Okay, so that signals that even Turkish GYO standards are having to adapt to these global trends around ESG reporting and better financial disclosure overall.
Yes, the pressure for global best practices in transparency and classification is clearly being felt.
All right, one final check before we wrap up. Despite all this strategic maneuvering, the high debt, the FX risk, the huge investments, are they still playing by the basic rules? Are they compliant with the fundamental SPK regulations for being a GYO?
Yes. According to their own report, they are fully compliant on the key measures, which is reassuring given the scale of everything else going on.
Okay, let's quickly run through those key compliance checks. First, asset concentration. Are they primarily invested in real estate?
Absolutely. The report states 91.99% of their portfolio is in real estate assets. The minimum required by the SPK is only 51%, so their focus is intense.
Second, leverage. How does their borrowing compare to the absolute limit?
We touched on this. Their borrowing ratio is stated as 47.48%, relative to their total assets adjusted for minority interests, it seems. The SPK allows GYOs to borrow up to 500% of their equity. So even with the recent increase in debt, they are using only a fraction of the permitted leverage.
They have substantial regulatory headroom to borrow even more if they wanted to or needed to.
Theoretically, yes. Lots of headroom.
And finally, are they actively using their assets or just sitting on undeveloped land?
The SPK has a limit on holding idle land. To Lanarsa. For 5 years or more, you can't have more than 20% of your portfolio sitting idle like that. ALGYO reports being at 9.24%.
Comfortably below the cap. So they're either developing their land bank or more likely focusing on these already developed income-generating or soon-to-be income-generating properties like Hillside and Bodrum.
That seems to be the case. They're actively managing or upgrading their core assets.
So the conclusion is structurally sound within the GYO rules, compliant with regulations, but executing a highly aggressive, high-risk, capital-intensive strategy with some significant vulnerabilities.
That sums it up well. #tag outro, anemone chikarium larvae samsos. So to try and pull all these complex threads together for you, the individual investor trying to make sense of ALGYO right now, we've synthesized what we think are the 3 most important takeaways from this 9M 2025 report.
Okay, takeaway number 1.
It's a narrative of extreme capital commitment.
Yeah.
You need to understand that ALGYO right now is not primarily focused on generating immediate shareholder returns through dividends. It's acting as an aggressive, hyper-growth investment vehicle.
They generate fantastic cash from operations.
Stellar cash flow, yes, that 2.3 billion TL. But they immediately funnel all of it and then borrow even more into these massive, highly concentrated bets on the future profitability of just 2 main luxury tourism assets. The Bodrum Hotel project is the overwhelming focus of that spend and risk.
Got it. Growth above all. Takeaway number 2.
The second key takeaway is the vulnerability of the bottom line. That slightly higher net profit figure we saw, it looks okay on the surface, but it was entirely dependent on their clever, tactical use of the hyperinflationary accounting environment.
You mean the net monetary position gain?
Exactly. That 136.7 million TL gain provided the essential shield needed to absorb the shock from that staggering 203.3 million TL explosion in financing costs. Without that accounting gain, the profit picture would have looked much, much worse.
So if inflation accounting rules change or end, or if market conditions shift so they can no longer maintain that beneficial net monetary liability position,
their reported profitability could suffer instantly and significantly. It's a structural vulnerability tied to the current macroeconomic and accounting regime.
Okay. And the third key takeaway, which really speaks to future investor returns.
The third is management's strategic conflict with regulatory change. We saw clear evidence with their decision to retain 100% of 2024 profits that their absolute preference is internal financing for their big projects.
But that puts them on a direct collision course with those new GYO tax rules.
Yes. The rules that mandate a 50% dividend payout or face a 30% tax penalty on retained real estate earnings. Management seems, at least based on past actions, to be prioritizing asset appreciation and getting these long-term projects completed over maximizing immediate shareholder income or even minimizing their tax bill.
They might be willing to pay the tax to keep the cash for Bodrum.
It seems possible. These 3 factors, the intense CapEx focus, the reliance on inflation accounting gains, and this looming conflict between reinvestment desire and distribution rules, really define the investment thesis for ALGYO right now.
It's a heavy bet on long-term asset value appreciation.
Leveraging inflation accounting to survive punishingly high interest rates in the short term.
And run by a management team that appears willing to incur significant costs, whether financing costs, potential FX losses, or maybe future tax penalties to achieve their strategic construction goals.
That's the tightrope they're walking. So here's where it gets really interesting for you, the listener, to think about going forward. What happens in the immediate aftermath when that massive capital expenditure for the Bodrum Hotel project finally winds down? That 2.88 billion TL, plus more to come, is a temporary but enormous drag right now.
The big question is, will the eventual shift from massive CapEx outflow to hopefully stable, high-value rental income inflow from the completed Bodrum asset, will that be enough? Will it dramatically boost their recurring core profitability and maybe finally solve those liquidity ratio issues we saw?
Or is there a darker scenario?
Or conversely, will the debt structure they built to finance all this growth, particularly the heavy reliance on short-term refinancing and that colossal unhedged 2.18 billion TL net FX liability, will that become a permanent, heavy burden, a fixed cost that continuously eats away at the operational gains from the shiny new completed assets?
Creating a situation where, yeah, they succeeded in building the fancy hotel, but they kind of failed to manage the balance sheet risk they took on to get there, especially if interest rates stay high or the lira keeps falling. Exactly. That intersection project completion meets legacy debt structure, meets currency exposure, meets management's response to the dividend tax dilemma that is the critical narrative to watch for ALGYO in the coming quarters.
A complex picture indeed.
We certainly hope this deep dive has given you the necessary structural and financial context to understand the very high-stakes strategy LLGYO is currently executing.
We'll catch you on the next deep dive. And please remember, if this analysis saved you hours of wading through reports and gave you better market insight,
Hit that subscribe button.
yeah, hit subscribe, give it a like, and maybe share it with someone who'd find it useful. Knowledge is always best when it's shared. Thanks for listening.